Welcome to Insider Events Master Your Money, a Millennial Guide to Home Ownership, presented by Fidelity. Here's our host, personal finance correspondent, Tanza Loudenbeck.
Hi everyone, my name is Tanza Loudenbeck and I'm a certified financial planner and insider correspondent. Thank you so much for being here with us today to talk about homeownership, and thanks to Fidelity for presenting this event. Insider's Master Your Money Bootcamps are month-long challenges broken down into simple, one-week exercises that help you get better with your money and take control of your money. Each challenge culminates in a live digital event, like this one, where we bring you more tools and expert insight. If you could take a moment at the end of today's session to share your feedback with us, we'd really appreciate it so that we can make future events as helpful as possible. You can use the dashboard on your screen to find out more information about today's speakers and find additional resources. You can also submit your questions there for our experts today, and we will get to them throughout today's session. But first, I have a question for you. Do you think that owning a home is the best way to build wealth? You can answer with a simple yes or no in the poll that's coming up on your screen. You have about 30 seconds to respond. For decades, owning a home has been considered a gateway to the American dream. But with student loans and increasing living costs, it's getting a lot harder for millennials to get their foot in the door. Not to mention the wild state of the housing market right now. Just consider this. Millennials in 2019 were paying nearly 40% more for homes than baby boomers at their same age. It's really tough out there, but half the battle is getting your finances in shape ahead of time. So if you're looking to buy a home, whether it's in the next month or the next year, we want to hear about it. Let us know why you're tuning in to today's conversation using the hashtag #MasterYourMoney on social media. And now it's time to introduce our guests. Not only are they experts in personal finance, but they're homeowners as well, so they know exactly what it's like to be standing in your shoes. Kelly Lannon is the Vice President of Young Investors for Personal Investing at Fidelity Investments. Welcome, Kelly.
Hi, how is everyone? Nice to see you again, Tanza.
Good to see you. We're also joined by Pam Capelod, who is a certified financial planner and the founder of Brunch and Budget. Hey, Pam.
Hi, thanks so much for having me. I'm excited to talk about this.
We're excited to have you here. So let's get back to this poll. I asked you all whether you think owning a home is the best way to build wealth. Looks like about 60% of you said yes, and about 40% said no. Pam, what do you make of those results? And in your opinion, how vital is homeownership to building wealth?
Yeah, I mean, it's really interesting. It's like almost split down the middle, in a sense, but it looks like it's leaning still towards yes. I feel like that with the stats that you shared with the student loan debt, it's much harder to get into home ownership as a way to build wealth at the beginning. And so the thing about home ownership and building wealth is it needs to be a very long-term strategy. I see the way that it really works out for people is if they're buying their forever home. If you're buying your starter home, if you're trying to buy something and maybe sell it in 7 to 8 years, we don't know what the market's going to look like. And so it's a much bigger risk to plan to buy something to sell it in less than 10 years versus planning to keep it in your family for 20, 30, or 40 years. That's really where homeownership can build wealth. And I really see homeownership as a way to build generational wealth. So to plan to keep that home within the family for multiple generations.
Kelly, what's your take?
Yeah, and so I guess I was a little bit surprised by the results. I'm glad it skewed more towards yes because I think for me, I really grew up like maybe most millennials out there, really thinking that buying a home was kind of my first step to start to accumulate wealth because I was actually putting money towards something I now owned. And when I say own, I'm not talking about my clothes or my shoes or going out to eat or anything like that, but something brick and mortar that I could actually see and say I have ownership over it. So that was kind of my opinion. Like for many younger people, that was the first step on truly feeling like I own something. Now, of course, and I'm looking forward to the rest of discussion, a lot goes into that statement, a lot of fear, a lot of financial, vulnerability. So I'm excited to talk more. But yeah, I thought actually it would skew a little bit higher. So it's interesting to hear that we have more of a 50-50 split versus what I was expecting, more of like an 80-20 type of split.
I'm with you. I was expecting the same thing. So this is interesting. And just a reminder to the audience to send in your questions for our experts. While they are not mortgage experts or real estate agents, we're going to be talking today about really getting your finances in shape to buy a home. So any questions related to that, send them over and we will incorporate them throughout today's conversation. But I want to start with just talking about renting versus buying. And I wonder if we can just dispel the myth right now that renting is a waste of money. Do either of you have a take on that?
Oh my gosh. So the whole concept of renting is throwing your money down the drain came from the Realtors Association. So I feel like that when you hear these kinds of things, consider the source, right? They have incentive to tell you, no, buying a home is the only way. You must buy a home. Renting is throwing your money away. And I think it's never throwing your money away to put a roof over your head, period. However, you need to do it, whether you're able to buy a home now, whether you're paying rent, that is always a worthwhile way to spend your money. And so I think when it comes to the rent versus buy thing, it's not so much that like one is better than the other, but does one make sense versus the other based on your current situation?
Yeah, and Pam, I could not agree more. I mean, think of all the things we spend our money on in our life, right? And you're saying literally to put a roof over our head is a waste of
Yeah.
money. So I am in complete agreement. I mean, everyone needs somewhere to live, whether it's for work, whether it's for your personal situation, whether it's to support your own family if you have kids. So I'm in complete agreement on that. And, I don't necessarily think there ever is a quote unquote perfect time to make that rent or buy decision. And for some, it could be a lot longer. I mean, we are part of a generation that home ownership is coming later in life. We don't necessarily go through this perfect flow of life events. And so I'm in complete agreement with you, Pam, and hopefully others on the call are as well.
I agree with both of you as well. And so, Kelly, what are some signs that you are ready to stop renting and buy?
Yeah, I think that's a great question. And honestly, like most of the way I approach my finances, I kind of look at it in steps. So if you don't mind, I'm just going to go through 5 quick steps to ask yourself, because I'm sure a lot of you are tuning in today with that very question. Okay, should I rent? Should I buy? Should I look in it? And honestly, for me, I knew I always wanted to own a home one day, but I didn't actually have a specific time period in mind of when that was going to happen. I was always just kind of saving towards it. It was definitely one of those longer term goals. So I don't know if others can relate to that. And, for some of you listening in, it is very much dependent on life events that are going on. If you need more space, or maybe you have the opportunity to bring more money in. But I just want everyone to ask themselves really these 5 questions. So the first is, are you truly in a financial position to buy? Okay. That might be like a duh statement, but buying a home is not the only expense you're going to have in your life. You might have to save money for an emergency, or there's other things in life that you're dealing with. So that's question number one. Are you truly in the financial position to actually buy something? Question number two, how long are you planning to stay? We'll talk about this throughout today's workshop, but when you buy, there are so many one-time expenses. Pam, I don't know about you, but I didn't even realize went into it, from like a brokerage fee to closing cost, or oh my gosh, it was
A
overwhelming. And
real
that
estate attorney. Yeah.
it, it's crazy. And if you're only trying to stay for a limited time, like you really have to think, how long am I going to stay in this house? Question number three, what is the better value in your area? Like if you're someone that wants to stay in the city and not necessarily move to the suburbs, renting actually might be a better option. I mean, look at the past year. Rents have fallen greatly in some of the cities as people were leaving the cities and moving to the suburbs. So depending on where you want to be, that is a very important question to think about. The fourth question, like, what if the cost of your home never rises? I mean, a lot of people, tend to buy homes because one day they hope to sell it back for more money and then maybe move to a different spot. But like, spoiler alert, that doesn't always happen, and you have to be okay with it. And then fifth and most final is like, what does your gut say? I know we're going to be talking about this a lot of times in sense of financial and this being a financial transaction, but honestly, owning a home is so much more than that. It's like a lifestyle decision, right? So that's really important. Like if it doesn't feel right, or if you're not quite ready, or if you're not ready to take on that responsibility, putting all sorts of financials aside, that's fine. That's okay. So definitely go with your gut.
I think those are all really important questions to run through. And we're getting some questions from the audience, and people are asking how to balance savings goals with saving for a home, saving for a down payment, whether someone is still paying off student loans or they want to be contributing to their 401k at the same time that they're saving for a down payment. Pam, do you have any advice for that?
Yeah, it really is all about priorities. So, one thing I will say is there is this rush to pay off debt, right? There's like, oh, student loan debt, it's so bad. I should get rid of that first before I do anything. And one, the way the credit system works, if you pay off your student loan debt, your credit score actually goes down because you've closed a debt, right? So it doesn't make sense, but that's what happens when you actually pay off your student loan debt is you regularly paying off your student loan is actually keeping your credit score up because it's probably one of your oldest lines of credit. So that's one practical thing. But when it comes to how important it is for you to pay down student loan debt versus saving your down payment, it's all about, it comes back to you. I love, Kelly, what you said about listening to your gut. If that student loan debt is something that is really weighing on you and you feel like you can't move forward until you pay it off, then do that first. But if you're someone who's like, this is the monthly payment, I can handle it, and I really want to own a home, then it's okay to deprioritize paying down that debt and instead push towards saving for a home. The thing about putting money towards a 401k versus saving for a down payment on a home is your retirement is much further away, and again, if buying a home is one of your main goals and that timeline is much sooner, then it's okay to prioritize saving for a down payment first versus trying to max out your 401k.
And so one of the hardest things about, this home buying process is really getting that initial down payment saved. That can be a huge hurdle for a lot of people, especially juggling debt payments and other savings priorities. Kelly, do you really need a 20% down payment? What other options are there?
Yeah, I think that's a good question. And so, do you absolutely need it? The answer there is no. But typically, why many people actually advocate to put down at least 20% of the home price is really to avoid paying private mortgage insurance or PMI. I'm sure we've all heard of that before. This is payments that are actually added to your mortgage payment. So it could add on an additional dollar amount to what you're already paying for the monthly mortgage. And why does PMI exist? Okay, like anything, it really does protect the lender in the event that you do default on your primary mortgage or your home goes into foreclosure. But the important thing to note is that it isn't permanent. Okay, so that is important. So let's say you cannot put down 20%. You're forced to pay that private mortgage insurance. It can be removed once a borrower pays down enough of the mortgage principal. So that's really important to know. Just like building your credit score, there's always ways to dig yourself out of it, okay, or improve upon it. So that's really important. But for many, there's reasons why they just don't want to pay down 20%. And one of the main reasons, and Pam kind of already touched upon this, is that you also have other things in your life that you're paying for. And what you don't want to do is actually hit that 20% threshold at the expense of deprioritizing the other financial aspects of your life, whether that is something like paying for your emergency fund or paying your insurance or other things. You don't want to completely sacrifice all your other finances just to hit that 20%. And some of the other options that I'm sure we'll hit upon this as well is that you can actually buy a home with as little as putting down, I think it's like 3.5% with an excuse me, FHA loan, Federal Housing Authority loan. So again, there are other options to look into, but I think one of the primary reasons why we always try to hit that 20% threshold is that a mortgage isn't cheap sometimes, and we don't want you to have to pay even more on top of that, but it is okay if you can't hit it.
So I will tell you, I bought my first house with an FHA loan, actually. So I put down 3.5%, and the the amount of time that would have taken me to save that 20% based on the salary that I was making now felt so far away. And so when I found out that the FHA loan was an option, I jumped at it and I did the math, and the difference between 3.5% versus 20% is huge, right? And so to be able to put that 3.5% down, pay a little bit of a premium with private mortgage insurance for a year or so, and get out of it within a year. So the way that it basically works is you pay private mortgage insurance until you either have 20% equity in the home that you put in yourself, or if the home value has risen to the point where now you have 20% equity. So within a year, the home price, the value of my home actually put me at that 20% equity threshold, and I was able to refinance out of the FHA loan and into a conventional mortgage. And that took away the private mortgage insurance and that lowered my payment within a year. I'm not going to say that works out for everyone or that's going to work out that way, but if you're someone who really owning a home is a number one priority and that 20% down payment feels like such a barrier, you can put down 15, 10, 5, or as little as 3.5%. And you don't necessarily have to do it through FHA, but there's a lot of places that will work with you. I also have been seeing lately as alternative down payment options, there are some lenders who are allowing you to put 10% down and then to take another 10% out as a loan. And that way you can circumvent private mortgage insurance by taking that extra 10% as a loan and putting that towards a down payment. So I've seen a couple lenders doing that with clients as well. I think a lot of lenders are getting creative because they also know that 20% is a lot for someone to save up for, especially if you're saving it up for all yourself and you don't have family support.
Absolutely. So, what exactly should people be budgeting for besides the mortgage payment and the initial down payment? What else goes into that monthly payment? Kelly.
Yeah, I'm just laughing because we already touched upon this. I feel like, what's that term? Like the full cost of home ownership. Again, I did not realize it until I actually bought my first home. So, what else do you need to budget for? So, for example, the home inspection. Before you buy a home, you want to check it out and make sure there's nothing hidden or sketchy or anything like that. You have to pay for that. Closing costs, you have to pay for that. Hiring a real estate agent or even a lawyer to help you out. Again, all that stuff comes with payments. Home insurance. We happen to live near the ocean. Our insurance was even more because we're technically almost in a flood zone. The other thing too, and Pam, I don't know about you, but we legit bought our home and immediately had to replace the garage door. About a month later, the AC broke. And again, this was having like a spotless home inspection. So there's so many other things to consider, no matter how nice of a quote unquote home you buy. In addition to those mortgage payments, you have property taxes, insurance, etc. And again, I don't mean to scare everyone by naming all these things and rattling it off. Is that I just had no idea that it wasn't just getting a mortgage, paying those monthly payments. One rule of thumb that we go by, and again, there's a million rule of thumbs out there, but I would definitely estimate maintenance costs of your home being about 1% of your home's value per year. So again, you always want to factor this in. And Pam, I think your point was spot on. Like the down payment isn't just the only thing that you have to think about. And so if you are worried about hitting that 20% threshold, look for other options, because I just rattled off about 10 more things that definitely go into the total cost ownership of owning a home.
Oh my God, those garages. That is so funny that you said that because we literally had to tear down our garage like the first day we moved in because we found out the hard way that our car didn't fit into it. And you will
Buy a
always
new
run
car,
into those surprises,
garage.
always, right? And even along the mortgage process, there are expenses like paying for an inspector, right? Paying for that appraisal, all of that is out of pocket. Paying for the attorney. In New York, the closing costs are super high. They're usually 5 to 6% of the actual purchase price. So you're looking at potentially like $20,000 to $30,000 extra on top of the down payment.
So, we have a
Yeah, it
question
adds
from
up.
the audience that relates to this, and someone's asking, how much money should I have in a house emergency fund? And so I think it's smart that they framed it that way. It's like not your typical emergency fund, not your everyday emergency fund, but something separate. Pam, what do you typically tell clients?
I loved Kelly's rule about the 1% of maintenance costs. One thing that I recommend to clients who are looking to buy a home is to anticipate the amount of money that they've been saving towards a down payment every month. Keep doing that. Pretend that you're still saving for the down payment because that money is going to come in handy when something unexpected happens to the home.
That's a great
Yeah,
rule of
that's
thumb.
great. Yeah, that is actually real. I'm gonna take that away myself on that. So yeah, because the unexpected, right? Like it's kind of crazy the amount of things that break all the time. And going back to renting, how nice was it, right? When you could call a landlord or call like the super of the building and be like, come fix it. Now it's like me and my very unhandy husband. No offense, Brendan, but you're not very handy. Now it's me and my unhandy husband like trying to figure out what to do, which is not always easy. So
So I think it's safe to assume that you can't just take your rent payment and turn it into a mortgage payment and assume that you can afford the same amount every month because there are a lot of other factors that go into owning a home. So, Kelly, I want to take some time and go through. Fidelity has some really great calculators that help people figure out how much they can really truly afford.
yeah, so we can definitely do that. So what I'm going to recommend, what I'm going to say, and Pam, I know we actually talked about this, during one of our prep calls, is that there are so many calculators out there, which I think is awesome, because in my opinion, that's one of the best things when you can actually put your personal information in these calculators and get a recommendation back. But I also want to caution that sometimes you'll see a different thing depending on the calculators you're using and how many you're using. So I did just want to be transparent around that. So why don't we actually walk through? Pam, do you mind if the two of us go through an example? Does that sound good? Can I ask you some
Let's
questions?
do it. Yeah.
Okay. Well, now, team on the call, I do apologize. I don't think we have the link, but we're actually going to send this out to y'all after. But we're going to go through a few questions again, just to get you thinking. And so we're going to go over two really quick activities. And I apologize, I'm looking on my other computers going through this. So this first calculator, okay, this is going to tell Pam if she should think about either buying a home or keep renting. So Pam, I'm going to ask you a few questions. Don't tell us the real answers unless you want to, because actually we won't know. But let's talk through this, okay? So first question, what is your annual household income? And I'll type it in the calculator.
125K.
Okay, we'll do 125K. How much are you currently paying in rent? Okay, so this is assuming, Pam, that you're still renting, you are not a homeowner.
Yes, so 2000 a
Right.
month.
That's pretty nice, especially if you're in New York or
I
Boston, where we
know,
both are
right?
from. How much would you be willing to spend on the down payment of your house?
Ah,
A hard question.
that is a hard question. I mean, I don't know, $50,000?
Okay, let's put that in here. How long will you keep your house?
I hope at least 10 years.
All right, so we'll put that in here. And then have you saved anything so far for your house?
So far, I have $15,000 saved.
Okay, that's pretty good, my friend. All right, so I apologize. I'm trying to get the calculator. 17. I hope that's okay. I'm giving you a little extra money. All right, so
Oh,
let's
nice.
get Pam's results as a result of that. So as a result of that, what it came up with is, Pam, it actually makes more sense for you to buy versus rent. So
Oh,
that's pretty good. Yes. It's actually calculating that buying, depending on, factoring in all the answers that you said, it would actually cost you closer to $1,000 per month versus renting. And then also looking at
oh.
your wealth over the longer term, by buying something more in about 10 years, you could actually accumulate about $300,000, which is pretty good. So, now again, the
Oh.
calculator here, you'll have to go through, and I'd recommend if people just want to search rent or buy, Fidelity, it will come right up. But the next question too, I know, Tanza, that you had asked this, how much house can I afford? So we'll take 2 minutes to just quickly go through this. Pam, we're going to look at you again. Let's make up some new numbers. What's your annual household income?
Let's go with 100K.
All right. How much have you saved so far? You want to save more or less this time?
I'll say 20K.
Okay.
I've been saving for a while.
Yeah. Yeah. Do you have any monthly debt? Student loan payments, car
Yeah,
loans,
I have a
care,
student
like that?
loan payment and a car loan. So let's say that's about 800 total.
Okay. Will you be willing to pay private loan insurance, private mortgage insurance, excuse me, PMI?
I'm going to say yes because I did.
Yeah. All right, so let's take a look based upon those questions. All right, so how much house can afford? So based upon the numbers that you shared with us, we are recommending or we're saying that you can afford about a $300,000 house.
That's really
I
cool.
know,
Okay.
which,
And
yeah,
one thing that I like about that second calculator too is I'm guessing that if you show that you've saved more, then it will also adjust the actual amount that you can afford. So if you're like, okay, I have $20,000 saved, what happens if I get to 50,000? What happens if I get to 60,000? And then that will give you some benchmarks for as you save, you'll be able to see how much more you can actually spend on a home.
yeah, exactly. And it also says, what is your monthly cost? How much would you have to pay for PMI? Because you hear that, you think it's very scary, but this is just calculating $100 extra a month, which again,
Hmm.
give up a meal a week, down payments. So I think that, unfortunately, I wish everyone could see these tools, but the point of that activity, and I hope that people start to see this, or these are the type of questions we want you to ask yourself, like I said, and again, Pam and Tans, I don't know if you own a home, but what was most surprising to me going through the process was how many questions, how many pieces of my financial history our mortgage lender had to go through. Oh my gosh. It was like, here, take my soul, basically. And so that was just a preview of some of the questions that will be answered. But if those felt intimidating, trust me, they will definitely ask you for more when taking a look at, how much they can actually loan you for your mortgage.
I think that's a great segue into the next topic, which is credit and credit scores. Because if you're buying a house with a mortgage, and most people are, you need good credit. So, Pam, first of all, what's the easiest way that someone can find their credit score or check their credit report?
Yeah. So checking your credit report right now, you can actually go on annualcreditreport.com. And since the pandemic, they allow you to actually pull your credit score every single week. So annualcreditreport.com is the only place to get your free credit score from all three credit bureaus, Equifax, Experian, and TransUnion. And now you can check it every single week. And we recommend actually checking all of them because you don't know which bureau the lender is going to use to check your credit. So check all three reports and check them as often as you feel. I recommend if you're looking to buy a home, check them once a month to make sure that nothing has changed or nothing new is on there. And then to check your credit score, it's a little tricky. Right now, a lot of credit card companies actually offer a free FICO score. And FICO, the Fair Isaacs company, is the credit score that most lenders use when it comes to checking your actual credit score. And FICO is probably going to be the most accurate way. You have to pay for it if you go to myfico.com. But again, a lot of credit cards, American Express, Chase, Discover, they actually allow you to check your FICO score for free now. Barclay, I think, does it now too. And then if you do want to check your credit score, I'm sure there are people out there who have Credit Karma and Credit Sesame and things like that. And the thing about those websites is you most likely found out in a very annoying way that their credit score is not the same as what the lender is using. And the reason why is because the way credit scores are calculated are kind of in this black box. And Credit Karma, what they're doing is they're taking your credit report and trying to calculate what your credit score is based on the information in your report. So while Credit Karma is not going to be the same as what a lender pulls, it's a great way for you to track and make sure that your credit score is going in the right direction. So if you're using something like Credit Karma or Credit Sesame already, then it's a great way to see, okay, when I add this thing or I take away this thing, what happens to my credit score then?
That's really helpful. And we have an audience question coming in. Someone's asking whether checking your credit lowers your credit score.
Ooh, yes, this is the biggest myth that I want to debunk. Checking your credit score does not affect your credit score. The only time that your credit score is affected is if you are trying to borrow money or if your landlord checks your credit. If an employer checks your credit, if you check your credit, if your cell phone company checks your credit, that does not affect your credit score at all. So when you check your credit score, it's known as a soft inquiry. And so that doesn't change what your score is. When someone else checks your credit who is trying to lend you money, that's known as a hard inquiry. And that's when your credit score goes down.
And
That was
so,
a great
Kelly,
question.
Good clarification for all of us. Kelly, why do you need a solid credit score to buy a home? Does it affect your interest rate? Does it affect your monthly payment? Does it affect the ability to get a mortgage? What does that play into?
Yeah, I mean, almost everything you do related to money and borrowing will somehow involve your credit history and your credit score. Pam actually mentioned a few different things. It can be checked if you're trying to borrow money to buy a car or a house in this conversation. If you're applying to buy a credit card, if you're even going to get an apartment. I remember coming out of school and I didn't have a credit score, so I was really in a tough spot with even trying to find an apartment. Pam also mentioned this, like your employers actually check your credit score to actually see if they can hire you for their company or not. So it is so important, and luckily there's a lot of things that you can do to build your credit, but it is a very important piece of people, understanding whether they can loan you things or they can trust you things. In the case of home ownership, your credit score will actually help to determine whether you qualify for a mortgage. And more importantly, it will affect the interest rate that lenders will offer you. So I think that's all really important. And it will also help to determine things like, how flexible or what type of mortgages you can get. It can also determine if you need to go the FHA, I don't know why I'm struggling so much with those letters, route or not. So again, so important to really determine how risky you are as a lender.
Yeah, and I will say too, from what I've seen, you probably need around 680 just to qualify for a mortgage, and then you're not getting the best interest rates, and you most likely need more like a 720 to a 740 to qualify for the absolute best interest rate. So good news is you don't have to have an 800 credit score to do this, but you do need to be in the 700 range.
That's a great benchmark. And Pam, actually, what are your tips for people who go check their credit and they see that they're not in that range or they're not where they want to be? What are some tips for improving credit? And how long does it usually take to see an improvement in your credit score?
Yeah, absolutely. The fastest way to improve your credit is to actually pay down your credit card debt. And so, credit card debt is considered revolving debt, which means that the balance can go up and down every single month. And it's the thing that sways your credit the most. The way that it works is that credit bureaus don't want to see your balance more than 30% of the limit. So, for instance, if your limit is $1,000 on a credit card, they don't want you to see you put more than $300 on your credit card. So that doesn't matter if you're paying it off all at once, if you're paying it all on time. If the balance creeps up to above 30% of the limit, your credit score is going to be affected negatively. So, one of the suggestions that I make, especially if you're someone who's paying off your credit cards in full, is to pay your credit card off more than once a month. You don't have to wait until the due date to pay off your credit card. So if you like to run up the balance but you don't want it to affect your score, pay off your credit card every time you get a paycheck. The other thing too is if you're working on paying down your balances, know that you don't have to pay them all down to zero, but try to get your balances down systematically to below 30% of that limit. So the first thing is to figure out what the limit is on your credit card and then to really calculate what that is. And that you'll see your credit score go up within 1 to 2 months. That's how quickly your credit score can change when it comes to balances on your credit cards. The rest of it is kind of just a waiting game. It's waiting for negative marks to fall off. It's waiting for time to pass. Every time you open a new line of credit, for instance, that's a hard inquiry and that affects your score for at least 12 months, if not 2 years. And so some of it is just waiting. There's also a new tool that Experian put out called Experian Boost, which I love. Is they actually will allow you to link your bank accounts and count utility payments and rent payments and even Netflix subscriptions as a positive mark towards your credit score. And so that's a really great tool. And there's also another tool out there if you're someone who's really trying to build your credit. Is there is a website called Isusu Rent, and there's a lot of these rent reporting websites coming out now in general. But the thing that I'm always wondering is like, rent is often our biggest expense, right? And most of us pay it on time. So why doesn't that positively affect our score? So a lot of people have been looking at that and saying, wait a minute, it should. And so there are a number of rent reporting sites out there right now where you can get your rent added to your credit report, especially if you're someone who pays your rent on time, and have it positively affect your credit score and increase your score that way as well.
Yeah, and
And
Tanza, can I just I think these are really important questions because I don't know about other folks listening in. I think that sometimes when people are thinking about buying a home, they're only just thinking about accumulating money towards that house, right? They're not thinking of trying to build your credit in parallel. So I just want to make sure we bring that connection to the forefront for everyone listening in. And I hope it's obvious through the conversation. But I know for me, it was kind of like the afterthought. I was like, oh, I'm going to keep stocking money away, keep stocking money. Now, luckily, I was doing it just naturally, building my credit score over time, which was really good. But I think sometimes don't realize that it has to work in parallel versus one thing versus the next. So,
I think that's a great point. And I mean, it's like a puzzle. There are all these little puzzle pieces. And Kelly, that was actually my next question for you is what else do mortgage lenders look at besides your credit when they're evaluating whether or not you're a qualifying borrower?
yeah, I think that's a really good question. And, I think that that is also something that for me, I was also surprised by because what we did do when we were looking to get a mortgage, and this is what I'd recommend everyone to do, is that don't just go with one person to get the possible rate that you're looking at. Think about it like most people I hope probably dated a lot of people before they found the one. Same with your mortgage lender. I remember talking to friends about, which mortgage lender to go to, which firm to work with. And we actually talked to quite a few because what happens is that actually people sometimes will offer you different rates depending on a few different things. I think we talked a lot about the credit score, and that's one thing they look at. But sometimes mortgage lenders will look at your debt to income ratio, the amount you're planning to put down on the loan, obviously, the down payment. These are some of the factors that will influence rates. So it's not just that credit score. And so this is sometimes why, when you're talking to different lenders, they might get, you might actually get different rates. You and your partner, you might go through and you might get different rates depending on the information that you have. If you have a higher credit score than your partner, for example, because a lot of it has to do with risk, you might actually get a lower rate than them. Or if a lender is offering different rates depending on the same exact qualifications, like I mentioned, a lot of that factors in. One company might look at your financial situation and they may take more into account that debt to income ratio. Well, another lender, their focus might be on your credit score. So these are just some examples. And so I don't want everyone to be surprised when they are talking to different lenders, they are getting different rates. But that is also why it's very important to talk to multiple people versus just go with the first person you speak to.
And what about that income piece? Pam, when you work with clients, do you have clients that have irregular income or freelancers or contractors and they don't have that, you know, 2 years of pay stubs to show a mortgage lender? What happens in those situations? Is it a lot harder to get a mortgage? Are there workarounds?
Yeah, I mean, unfortunately, mortgage lenders do not love small business owners. The whole point of a mortgage lender and the underwriting process is Kelly mentioned it a couple times is it's really assessing risk, right? One way is your credit score and one way is the consistency of your income. And with freelancers, there's this idea that like the money could disappear tomorrow. That's like how an underwriter or a mortgage lender feels. And so with freelancers, the requirements in terms of paperwork and we have to submit are usually more strict. They usually want to see at least 2 years of tax returns, if not three. And you need to show that every single year your income has either stayed the same or increased. So if for some reason, like I had a client who took like a few months off 1 year, and so her income showed as less in the most recent year versus the year before, and the lender questioned that. And she needed to write a special letter to explain why her income went down. So just know as a freelancer or as a small business owner that your financials are going to get scrutinized much more than if you had regular W-2 income.
Yeah, and
That's good
they'll
to
ask you
know.
for everything, right? Like any, like depending on how you get paid, not even people who are in the small business industry. Like if you get, bonuses or if you have multiple bank accounts you're moving money in and out of, like they'll look at every single bit of that and ask so many
Hmm.
questions. And I personally, I have to be honest, I was not really prepared for that. I didn't realize that, moving money from one account to the other, they would be like, well, why did you do that? What was the need for that? So these were things that, again, I had no idea going through the process that, they did scrutinize every single transaction that was coming in and out of your account.
Yeah, and like you said too, Kelly, every lender is going to be different because every underwriting team is different. So some underwriters will let something fly, whereas other underwriters are like, "Oh no, like I can't have this situation going on, or I don't feel like this is a risk worth taking." And so that's the other thing, especially in terms of choosing a mortgage lender, is yes, choose the person with the lowest rate maybe, but also choose the mortgage lender that you feel like is going to advocate for you, because the
Right.
mortgage lender and the underwriter talk to each other. And in this situation, the mortgage lender is on your side, the broker that you're working with, whoever it is, and the underwriter is on the bank side. And so if you have a good relationship with your mortgage lender, then it'll be much easier to go through the mortgage process.
That's actually an excellent point, because when we were going through it, the first individual we spoke to, I think actually the rate was a little bit lower, but the second individual we spoke to, he was just awesome. You know what I mean? Like,
Yeah.
answered our questions, was so responsive, and of course, yeah, I'm sure he was selling us something, but again, he just was so very helpful, and I really felt like he was on our side versus simply just, seeing our numbers and then just giving us a number back. So I think that's actually a great point, Pam. And that's actually why we ended up choosing to go with the firm that we did for our
Mhm.
mortgage. So,
Sounds like they really crack open your financial life. So there's a lot that, people can do ahead of time to get those things in order, know where everything is. Um, but even before you're home shopping and applying for a mortgage, there's something called mortgage pre-qualification and mortgage pre-approval. Pam, can you explain the difference between the two?
Yeah, and I will tell you, pre-approval is the one that people want to see right now. So the main difference between mortgage pre-qualification and mortgage pre-approval is with pre-qualification, the lender is just asking for your numbers. They're not asking for any backup. They're not checking your credit score. They're saying, "Hey, based on what you told us, this is what we think you can afford to buy a home," right? And so that's pre-qualification. Mortgage pre-approval is we need all your paperwork. We're going to check your credit score. Your credit score is going to take a hit, and that way we know for sure that the numbers you told us are real and we can back them up. And so most sellers and most real estate agents are going to want to see a mortgage pre approval to show that you're serious about buying a home.
So that's something that could help in a competitive market like this.
Yeah, absolutely. The thing is that you can start shopping around and looking around, but I think that from what I've seen, especially because it's so competitive right now, people want to know that there's a bank behind you, right? People want to know that you're going to be able to get that mortgage. So that mortgage pre-approval is really the first step when you're ready to start the home buying process in a very serious way.
yeah, I will
Oh,
share this too. And I don't know if either of you guys can relate to this. It was very interesting. Is that often, even with that pre approval amount, sometimes a bank will actually give you a loan for more than the house that you actually want to pay for. So we got approved for something that they were going to lend us a lot more money, and I was like, oh my gosh, I don't think we actually should be borrowing that much. So
Mhm.
that's a big thing, especially for first time home buyers. Sometimes you can make that mistake and actually end up borrowing more than you ever wanted to or you ever even thought you would get. And that can actually end up, affecting you in the longer term, because you never want to obviously end up being quote unquote house poor. My mom always used that term with me, house poor with little left, that you can actually go on and make your monthly mortgage payments. So that's just, a little bit of caution when you do get that pre approval amount. Does that mean that's the amount that you have to go for? No, not necessarily. And sometimes that amount ends up being a lot bigger than you ever imagined or you ever should actually take on.
that's a great point of caution. And we have an audience question. Someone's asking whether it costs money to get a pre-approval, and if so, how much typically?
It absolutely should not cost you money to get a pre-approval. So if a lender or if a mortgage broker is asking for some money up front, go the other way. Pre-approval is totally free. The mortgage lenders are in the business of doing mortgages, and so the beginning process is them vetting you and you vetting them, and it should not cost you any money.
Noted. And we have another audience question. Someone is asking, how many different lenders should you consider?
That's a good question. I am the type of personality where I'm like, I want to make sure that I'm getting the absolute best rate. So I have the instinct to like go to 10 different lenders, right? And my husband has tempered me and he's like, maybe we just go with three. So it's going to depend on your personality, but really and truly, you don't need to go to 10 different lenders. I would say shop around for 3 to 4. So the way it affects your credit is when you first have a mortgage lender check your credit, that affects your credit score negatively and your score goes down. But you have this 14 to 30-day window and sometimes 60-day window. I've had lenders tell me different things, but you have this window of time where you can shop around for a mortgage and it doesn't affect your credit score anymore. So you can have your credit score checked as often as you need to within this window while you're shopping for a mortgage, and your credit score is going to stay the same. But yeah, 3 or 4 is probably fine. And really, again, it's you don't have to get the lowest rate. A big part of it is really a personality fit and getting that feeling that they're going to get the job done for you.
That's
We have
funny that you want. Yeah, I think I'm much more like you. We ended up going with two, and honestly, where we started, and I don't know about you, Pam, is that I can get very overwhelmed by the Google searches. So we actually went and talked to some of our friends, especially some of our friends who lived in the same area that we were looking to buy, and they gave us recommendations. And so I think we compared two, and like I said, we ended up choosing the gentleman who we ended up working with, mostly due to personality, because we honestly felt like he was like part of our team, and on our side, and that helped a lot through the process because we had a lot of questions. And sometimes you feel stupid asking some of them, but I have to say, like, never ever stop asking those questions. That goes for all finances, but especially in the home buying process.
Agreed.
We have another audience question. Someone is asking if we can talk about mortgage term years. So they're saying they're in their 30s and they're wondering if they should take a less than 30-year mortgage. Pam, do you want to take this one?
Yeah, so I am all about flexibility because we don't know what our finances are going to look like, in the next 30 years, the next 10 years, the next 5 years, whatever it is, right? So, one, it's worthwhile to check to see if a 20-year mortgage or a 15-year mortgage payment amount or monthly payment is something that is manageable for you because usually the interest rate is lower if you take a mortgage term that is less than 30 years. The tricky is though, you're on the hook for that mortgage payment amount, right? And so the thing that I recommend to clients, especially if you want to have that flexibility and you want to have room for the unexpected to happen, is get the 30-year mortgage and make extra mortgage payments. So if you make an extra couple $100s a month, then it won't take you 30 years to pay off that mortgage. And if you're someone who looks at that 15-year mortgage payment or 20-year mortgage payment and you're like, that's not really doable for me, but maybe it will be in a few years. Get the 30-year mortgage and then work your way up to that payment amount that will pay off the loan in 15 or 20 years instead. And the best part about having that lower mortgage payment is you have the flexibility to put more payments towards it or get back to whatever the 30-year payment is. What if you lose your job? What if you have an unexpected emergency? What if you unexpectedly start a family, right? There's so many things that can happen. And so, especially for a payment that's so big, I'm all about having as much flexibility as possible, unless you're very sure you can handle the 15 or 20-year mortgage payment.
I want to go back to credit scores really quickly. We have a good question from someone that's asking, what if you're married and your partner has a lower credit score? Is it better to have the person with the higher credit score buy the home alone? And Kelly, you mentioned this briefly, having different credit scores than your partner. Can you talk about this?
Yeah, and again, I already kind of threw him under the bus once today, so I hope he's not listening. But yeah, I actually did have a higher credit score than my husband. Not by much, Brendan, not by much, but we actually used. I know, I feel horrible. I don't think he's listening, but still, yeah. So I actually did have a higher credit score than my husband. So we actually, quote unquote, used my credit score when we were applying to get our loan. However, that doesn't mean that the loan is only in my name. It's actually in both our names. We just happened when we were applying for the loan, and I don't know all the back end. Pam, if you do, please speak up. But again, I don't know why it ended up working that way. But again, I had the higher credit score, so that was what we had actually shared. With our mortgage lender. They still had Brendan's. Don't get me wrong. So they had needed all of his information as well. But my credit score actually helped us get a lower rate than his. But both of us are still on the loan, so it's not the home is not just in my name.
Wow. So that is awesome. Usually, lenders default to whatever the lower score is. And so I haven't actually run into a lender who's like, you can choose the higher score for us to qualify your rate. So that's really cool to hear that lenders are doing
Yeah.
that. For the most part, what I see is lenders either automatically default to the lower score or they take the average of the two scores. So I have had clients who the person, especially if the scores were very different, I have had clients where if they could qualify for the loan based on one income, then they just put one person on the loan, but you can put both people on the deed or the title of the home. So if you're comfortable with having one person on the mortgage and then having both of you own the home, then that's a great setup as well. And then also, as your partner builds up their credit score, if you ever go to refinance, and you can refinance with the loan in both of your names.
That's a great point. And for this, I'm going to pull one more audience question because I'm a tax nerd and I like this question. But someone's asking, what are the tax benefits, if any, to buying a home? Do either of you want to jump in?
Yeah, so I will tell you, they used to be great. And that was back before 2018.
Yeah.
So with the Tax Cuts and Jobs Act, one of the things that happened was that the standard deduction was doubled. So for individuals, the standard deduction went up from $6,000 to $12,000, which is good news in terms of like you don't need to itemize. The other thing that happened though was they capped the amount that you could deduct of your property tax and your state taxes to only $10,000. So what I've been seeing is clients actually are more likely, about 90% of people actually take the standard deduction, even if they have a mortgage, even if they have mortgage interest. And so there's not really a tax benefit for right now unless you're itemizing. If you're itemizing deductions, then you can actually deduct your mortgage interest up to $750,000 of the mortgage. So it's a really great tax benefit if you're in a position where you're itemizing your deductions.
I think we
Yeah,
should
thank you.
also
You
touch
just
on.
caught me thing though, Pam, because sorry if you don't mind if I pile on, but I also thought, and again, maybe a myth, maybe not, is that owning a home would actually lead to higher tax breaks. I don't know, that was just like one of those
Oh,
things I had always heard. Owning a home, having kids, etc. I was like, oh, this will all contribute to lowering my taxes. We haven't really seen much, but I will say this: depending on if you are a first time buyer, to your point, Pam, it's not like maybe what it was. I remember when Obama was in office, there was a lot of first time buyer benefits, yet those first time buyer benefits still do exist. So I would just say anyone who is looking to buy a home for the first time, make sure you ask the questions. There are certain state programs that are out there. There are certain tax rates. There are federally backed loans as well. So that's the only thing I would just advocate for. If you are a first time buyer, make sure you do your research.
And we have a couple people asking for us to repeat the definition of private mortgage insurance. What is it really? Where does it come from? And how much does it add to your monthly payment? Pam, can you take
yeah.
this
So
one?
totally. So private mortgage insurance is literally the lender saying, and this is the reason why it exists is because there's stats out there that people who put less than 20% down on their home are more likely to default on a mortgage. So the mortgage lender's like, oh, no, 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 no. We don't want to take that risk unless you pay this thing called private mortgage insurance. And that's literally you paying an insurance policy for the benefit of the lender. So if you default on your mortgage, the lender gets made whole by this insurance and the insurance pays for the rest of your mortgage. And so every single month you're required to pay private mortgage insurance. It comes in two places. The first is upfront PMI. So when you close, you have to pay an upfront PMI or private mortgage insurance amount that's usually around 1% of the loan amount. And that gets rolled into your closing costs or it can get rolled into your mortgage itself. And then you pay a monthly PMI that's usually between 1% of the mortgage amount divided by 12. So it comes out to between $300 to $500 every month. And it's based on how much you put down. So the less you put down, the higher the private mortgage insurance you pay.
Right. And as you mentioned before, once you get to 20% equity in the home, that monthly payment falls away and you're no longer responsible for
So
it.
it doesn't automatically fall away. So private mortgage insurance, if you don't refinance out of your current mortgage, stays there forever. So when you hit that 20% equity, then the only way to get out of PMI is to refinance into a conventional mortgage.
Good to know. Okay. So you both have obviously been through the home buying process. You've shared a lot of your, firsthand experiences with us. I want to ask each of you, what is your best piece of advice for a first-time home buyer? Kelly, let's start with you.
Yeah, and I've kind of hit upon this a little bit. Buying a home was so exciting. We luckily bought a home at the end of 2019, and I mean, honestly, our timing couldn't have been better with the chaos that was 2020. But it can also be a little bit scary, and I don't think anyone really talked about that, at least with me. It was always seen, even by my parents, as a rite of adulthood, a rite of passage. They were definitely the people, as we alluded to at the beginning of the session, who said renting was throwing your money away. I mean, that's how they think. So I always viewed it as a very exciting thing, but it wasn't until I went through the process that I realized that it can be a little bit scary. It can be a little bit intimidating. And they definitely look through every single aspect of your financial life. Now, that doesn't at all push aside any of the excitement I am to now own a home and have a place. So that's great. But it was definitely something that, I did. I don't think I was expected. I expected. So even you attending this session, everyone listening today, I mean, I give you great kudos for. But I think one of the best, pieces of advice that I can, give for anyone, especially now, because I even saw this with a few of my friends, jumping in too fast to the market, or waiting too long to put in an offer. It can be, a risky thing. I think that a lot of people like flat are like, oh, I need to jump in the market, I need to own a home, and they didn't really maybe consider like the overall cost of the home or all the costs that came after even buying the home. So that would be the only thing, is make sure you take your time, don't jump into anything. You will find a home that's right for you. There's plenty of homes out there. I think sometimes too, you put in an offer and you're like, oh my gosh, if I lose this, I'm done for. I'm never going to find a home that will be for me. That is not true at all. There's plenty of places out there, and you will you will find the right place. And I'm someone who believes everything does happen for a reason. So stay calm. You will find the perfect place for you.
I love it. Thank you for taking us through like your own mental, emotional roller coaster, because that is totally what it feels like. That is totally what it feels like. And I think that to piggyback off your advice, my big piece of advice to my clients is to have a non-negotiables list. Kelly just talked about how emotional it was to like make an offer, lose an offer. Oh, I'm like looking at houses. Like I had a client who was like, we've looked at 60 houses, in the last month. So it's exhausting, it's emotional. And before you really dive into that process, I recommend having your must have list, right? Your non negotiables, must have, whatever you call it, write it down. Do it with your partner if you're buying a home with your partner, and write down one, what's the max amount that you're willing to spend on a home, right? And then also write down what are the things that your home must have, or you walk away, right? Because lots of things can convince you otherwise if you don't have that list. You have, very convincing realtors. You have this feeling that there's going to be no houses left for you, especially right now. And if you have that list and use that as your North Star in a sense, then it gets easier to walk away from things. It gets easier to be able to negotiate with a clear head, because you're like, hey, I am not willing to give these things up, or I'm only willing to give these things up if the house costs a certain amount. And I will tell you, we bought our second home in December. So we've gone through this process twice now. And we made lists both times. And having those lists literally written down, not just in your head, not just talking it out, but having them written down and using it as a reference point when you are in that very emotional decision making process is going to make such a huge difference in terms of you really getting the home that you really want.
Thank you, Pam and Kelly, for all of your wonderful insights today. And thanks to our sponsor, Fidelity. We want to hear what you took away from this event. So please share with us on social media using the hashtag Master Your Money. A recording of this event will also be available on Insider's social channels if you want to revisit it later. In a few moments, a survey will also come up on your screen, and we'd love to hear your feedback. Thanks, everyone, for watching.